Today, January 27th, 2026, the global gold market is once again commanding the attention of investors around the world as the precious metal trades at historically elevated levels. After a remarkable rally over the past year and a half, driven by geopolitical uncertainty, macroeconomic shifts, and changes in monetary policy expectations, gold continues to be one of the most watched assets in global financial markets. As of today, gold prices are hovering above $5,000 per ounce, with previous sessions seeing prices briefly touch and even exceed $5,100 per ounce, new all-time highs for the yellow metal. Even though there's been some intraday volatility and slight pullbacks, the overall trajectory remains firmly bullish. On January 27th, gold futures opened above $5,000 and, despite a minor slip of around 0.2% from recent peaks, are still significantly higher than where they began the year. This extraordinary price movement isn't happening in isolation. The most recent data shows that gold has already gained around 17% so far this year and continues to build on the incredible momentum established throughout 2025, when it logged one of its biggest annual gains in decades. One of the primary forces behind this rally is the growing safe haven demand as investors seek protection against a backdrop of global economic and political uncertainty. Trade tensions between major economies, including disputes involving the United States and several of its trading partners, have pushed investors toward gold as a hedge against risk. Geopolitical instability remains a constant theme influencing markets. Heightened tensions in various regions, along with unpredictable trade policies and the threat of tariffs between major economies, have spurred demand for assets perceived as stores of value. As a result, gold's price surge reflects more than just short-term speculation. It mirrors a broader shift in how global investors are positioning their portfolios amid uncertain times. Another contributing factor to gold's strength is the weakening of the US dollar. Since gold is priced in dollars, a softer currency makes bullion relatively more attractive to international buyers, and this dynamic has helped underpin recent gains. The diminished strength of the dollar has made gold more affordable for holders of other currencies, encouraging international investment. Institutional factors are also at play. Central banks around the world have been steadily increasing their gold reserves, diversifying away from traditional reserve currencies. This trend reflects concerns about long-term currency stability and inflation risk, further supporting the high price levels we're seeing today. Analysts have pointed out that central bank buying has been a structural pillar of the gold market, smoothing volatility and keeping the long-term trend higher. Major financial institutions have responded to these trends by revising their gold price targets. In recent days, banks like Deutsche Bank have lifted their gold price targets significantly, with some projecting that gold could reach as high as $6,000 per ounce by the end of 2026, a dramatic increase from previous estimates. These forecasts are based on structural drivers such as geopolitical risk, inflation fears, and ongoing changes in monetary policy across the globe. Despite the strong run, the gold market isn't without its short-term price fluctuations. On January 27th, gold experienced a mild pullback from the highs it hit earlier this week, with prices dipping slightly before stabilizing above the $5,000 level. This kind of profit-taking is common after sharp rallies, and traders are watching for signals from macroeconomic data releases and central bank communications that could influence the next big move. The Federal Reserve's policy stance remains one of the most influential forces for not only gold, but all risk and safe haven assets. With expectations that the Fed may hold interest rates steady in the near term, the opportunity cost of holding non-yielding assets like gold remains low, a condition that continues to make the metal attractive relative to bonds and other yield-bearing securities. Compared with other precious metals, gold's performance has been particularly strong. Silver, for example, has seen more volatile price action with sharp swings, while platinum and palladium have struggled to match gold's pace, despite also benefiting from safe haven flows. The resilience of gold relative to its peers underscores its status as the go-to hedge for risk-off market environments. Investors and analysts are keeping a close eye on global economic data. Inflation trends, employment figures, and manufacturing output from major economies all feed into investor expectations for future interest rate policy, and these expectations, in turn, influence gold prices. Any sign that inflation remains uncomfortably high or that monetary authorities are becoming more dovish could send gold prices even higher. Conversely, unexpected economic strength could prompt profit-taking or consolidation after recent gains. Looking at the broader picture, the gold bull market we're witnessing in early 2026 is rooted in both short-term geopolitical concerns and long-term structural shifts. Unlike previous gold rallies, which were often driven by fleeting market events, the current uptrend reflects deepening investor preferences for real assets that can hedge against currency risks and economic uncertainty. For global investors today, gold is not just a commodity, it's a barometer of market confidence, geopolitical risk, and economic direction. With prices comfortably above $5,000 per ounce and forecasts pointing higher, the precious metal remains a central focus for anyone tracking global financial markets on January 27, 2026.